What if I told you the warning signs we're seeing in today's economy have eerie parallels to 2007? What if the data shows we're already in the early stages of a financial crisis that could make 2008 look mild by comparison? In this video, we're going to connect the dots between three terrifying trends: a housing market that's becoming completely unaffordable, a consumer credit bubble that's starting to burst, and banking sector vulnerabilities that could trigger a domino effect. But here's what makes this crisis different from 2008, and in some ways, more dangerous. Stick around, because what we've uncovered will change how you view the entire economy. Let's start with the housing market, because what we're seeing isn't just about prices being high, it's about fundamental structural collapse. The data shows foreclosure starts are up 13% year over year. But that number alone doesn't tell the full story. We're seeing specific regions hit much harder than others. States like Florida, Nevada, and Texas are experiencing foreclosure rates 2-3 times the national average. Why? Three key reasons. First, the pandemic-era assistance programs have completely expired. The mortgage forbearance programs, rental assistance, and stimulus checks that were propping up the market are gone. Second, we're seeing the impact of regional economic shocks. Major employers in certain markets have conducted layoffs, and when you combine job loss with mortgage payments that have doubled for many homeowners, you get a recipe for disaster. Third, and this is crucial, insurance costs in states like Florida and California have skyrocketed. Many homeowners are seeing their insurance premiums increase by 200 to 300%. When you add $1,000 per month to your housing costs, just for insurance, something has to give. Now let's talk about what's happening with consumer credit, because the problems extend far beyond mortgages. The auto loan market is showing massive stress. Repossessions hit 1.73 million vehicles last year. That's the highest level since 2009. But here's what's even more concerning. The average monthly car payment has reached over $750 for new vehicles and over $550 for used vehicles. When people stop making payments on assets they need to get to work, that tells you household budgets are breaking at the seams. But it doesn't stop there. Credit card delinquencies have been rising steadily since 2021. The share of credit card debt that's over 90 days delinquent has increased from 1.48% to 3.2% in just 3 years. What's driving this? It's the perfect storm of inflation eating away at purchasing power, the exhaustion of pandemic savings, and the resumption of student loan payments. Millions of Americans are having to choose which bills to pay each month. Now, here's where it gets really concerning. The banking sector vulnerabilities. You've probably seen headlines about regional bank stress, but most people don't understand how connected this is to the consumer debt crisis. Several regional banks have taken massive losses related to auto lending and other consumer credit. One major bank took a $170 million charge related to the collapse of subprime auto lender Tricolor. But here's the key insight. These aren't isolated incidents. They're symptoms of a broader problem. When consumers stop paying their auto loans and credit cards, it doesn't just hurt them, it hurts the banks that hold that debt. And unlike 2008, today's banking system is more interconnected than ever. Problems in auto lending can quickly spread to other types of credit. One banking analyst described it to me as death by 1,000 cuts. No single failure might be catastrophic, but the cumulative effect could trigger a liquidity crisis. Now, you might be thinking, this sounds exactly like 2008, but there are crucial differences that make today's situation both better and worse. The good news: lending standards for mortgages are much tighter today. We're not seeing the ninja loans, no income, no job, no assets, that fueled the last crisis. And homeowners have record amounts of equity, which provides a cushion. The bad news: the consumer debt problem is more widespread. In 2008, the problem was concentrated in mortgages. Today, it's mortgages, plus auto loans, plus credit cards, plus student loans. Also, the banking system is dealing with multiple simultaneous pressures: commercial real estate weaknesses, consumer credit deterioration, and the impact of higher interest rates all at once. Perhaps most importantly, the government has less firepower to respond. After the massive stimulus during COVID, there's less political will and fiscal capacity for another huge bailout. So how could this actually play out? Let me walk you through the potential domino effect. It starts with consumer stress, people falling behind on auto loans and credit cards. This leads to losses for regional banks that are heavily exposed to consumer credit. As these banks take losses, they tighten lending standards across the board. This makes it harder for everyone to get loans, for cars, for homes, for business expansion. Tighter credit leads to reduced consumer spending, which hurts businesses. We're already seeing this in retail earnings reports. Businesses respond by cutting costs, which means layoffs. Higher unemployment means more people can't pay their debts, creating a vicious cycle. The Federal Reserve is in a terrible position. They can't easily cut rates to stimulate the economy because inflation remains stubbornly above their 2% target. This isn't speculation. We're already seeing the early stages of this play out in the data. Now, the most important question: what can you do to protect yourself? First, if you have variable rate debt, especially credit cards, prioritize paying it down. Interest rates on these are at historic highs. Second, build your emergency fund. The traditional recommendation of 3 to 6 months of expenses might not be enough in this environment. Consider aiming for 6-9 months. Third, be very cautious about taking on new debt, especially for depreciating assets like cars. If you don't absolutely need a new vehicle right now, consider waiting. Fourth, diversify your banking relationships. Don't keep all your assets at one regional bank, especially if they have high exposure to consumer credit. Fifth, if you're struggling with mortgage payments, contact your servicer now. Don't wait until you're behind. There are still assistance programs available, but you need to be proactive. So where does this leave us? Based on the data and expert analysis, here's the most likely scenario. We're looking at a prolonged period of economic weakness rather than an immediate dramatic crash like 2008. It will be a slow burn crisis rather than a sudden collapse. The housing market will remain stuck. Prices may not crash due to inventory shortages, but transaction volume will remain depressed as affordability issues persist. Consumer spending will continue to weaken, leading to more business failures and layoffs. The Federal Reserve will be forced to walk a tightrope. They may cut rates slightly to prevent a crisis, but not enough to truly stimulate the economy given inflation concerns. The worst-case scenario: if we get an external shock, a geopolitical event, another pandemic, or a major corporate bankruptcy, that could accelerate the timeline dramatically. The key takeaway? This isn't 2008, but in some ways that makes it more dangerous because people aren't as prepared. The warning signs are there if you know where to look. This is a developing situation, and we'll continue to monitor it closely. What are you seeing in your local economy? Share your experiences in the comments below. Are housing costs forcing difficult choices? Are you seeing businesses struggle? If you found this analysis helpful, please like this video and subscribe with notifications on. Thanks for watching, and remember, in times of economic uncertainty, knowledge isn't just power, it's protection.